Hello, everyone, and welcome to Confident Compounding with Corey Kramer. Today, I'm going to talk about Fed interest rates and the recent interest rate cut. I realize I'm a few days after the fact here, maybe a week after the fact, but I wanted to take some time to think about this a little bit and figure out exactly what I wanted to say. It's been a while since I've commented too much on the Fed, and then I couldn't remember what I said in my more exclusive Fed comments in the Cyclical Investors Club and Confident Compounding over on Patreon, and what I had said publicly. So I'm going to cover a couple of the main points that I have today that are going to probably be a lot different than what you've heard from anyone in the past. I have kind of my own view on this. And usually when I make a video or write something like this, at least a couple bankers contact me and say, Corey, come on. But I'm going to tell you it anyway. So I just pulled up this article for something to look at here. I might go to Fast Graphs instead. But the new Fed governor, Miran, I watched him on Bloomberg this morning giving his explanation of why he thinks there should be these huge rate cuts, even though everything's fine, which is always kind of interesting to listen to. And I want to give my take on why I think the Fed they've actually cut rates now, at least started, even if it's not as much as he wanted. I'll just pull up a fast graph of S&P 500 here. And so here's my take. So I view the Fed it's always complicated because there's different things that are going on, but the Fed main job is to protect the banking industry. Now, sometimes I say that, and bankers will disagree, that the Fed is not there to protect them, and that's true for an individual bank, or a handful of banks. If they're doing things they shouldn't be doing and taking on too much risk, we saw this with with Synchrony and what was it first? Nah, I'm going to say the wrong one. Whichever the two that got shut down a couple years ago. They aren't protecting every bank. They're protecting the banking system, right? And so you got to put yourself in the shoes of a lender, okay? So much of the world, in my opinion, can be explained much better from the lens of a lender and a borrower. This goes for governments as well as businesses, as well as individuals, than it can the traditional political left, right, whatever we decide to call things now. And the lender-borrower relationship goes back far longer than modern capitalism. So if you read, I think you can even see it in the frame here. Dun, 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 dun. That book right there, it's called Interest Rates. Very good one. The history of interest rates, basically. Lender and borrower history goes back a very long time. There's another great book on U.S. debt and borrowing that has mostly to do with consumer debt called Debtor Nation. I don't know if it's over on one of my shelves. I can't see it through my camera, but it's around here somewhere. And that's also a great book that probably almost nobody's read. It's a dense book. It's not fun to read, but the information in it is extremely valuable, and I don't think I've ever read it anywhere else in such a comprehensive way. So if you put yourself in the position of, a lending business, you want a system where people and businesses and the government and whatever, it depends on what type of lender you are, but I'm mostly going to talk about consumer lending in this video. You want a situation where people need to borrow money. You don't want people to just have cash sitting around where they can go out and buy whatever it is, a new car, a house, whatever. You don't want where people can just go pay cash for it, because then you don't make any money, right? You need people to borrow, need or want to borrow money from you so that you can earn interest on those lendings, and that's how you make money, right? I realize there's other ways to make money, fees and all kinds of other stuff. I'm just talking about borrowers and lenders here. So if enough people are doing so well that they don't ever need to borrow very much money, that's not a very good situation for banks, like consumer banks, consumer lending. But so you want interest rates to be high enough to kind of keep the economy, you don't want the economy to get too hot, right? But the thing is, you don't want borrowers to default on the money that they've borrowed. There's basically two ways to lose as a lender, and this goes for bonds, or if you're buying government bonds or corporate bonds or anything. One way is that you don't get your money back, right? So just take it. Somebody goes and gets a car loan or whatever, and then they can't make their payments, and so the bank doesn't get their money back. Well, maybe they can go repossess the car, but that costs money. And in the end, the bank's taking some kind of loss on that. That goes for just about any kind of loan, except for student loans, which I'll get to in a moment. So you want the economy to be good enough that people can afford to pay back their loans. And you want to loan to people, that's what credit scores and all that are for, so who have a high probability of paying you back the money that you borrow them. And that's how you make money. So you have to have this balance of both things going on. And the Fed is, in my opinion, heavily involved in that. So that's one way you can lose money as a lender. But the second way you can lose money is inflation, right? You loan money out at 2% and it takes you 10 years to get it back. And we have 4% inflation a year during that time. Well, you lost money as a lender in real terms. So that's why the Fed cares about inflation. That's the only reason they care about inflation. All the other stuff, it's bad for people and blah, blah, I just ignore all of it. It's complete garbage. They don't want to lend money and not get the same amount or more back. It's very simple. So you have to keep inflation down so you can get your money back in real dollars on the interest that you make. But you also can't have your borrowers defaulting on you, because then you still don't get all your money back. All right. To me, this is like very basic economics, but I don't know if people just don't. Well, I'm not going to speculate on all the reasons why, but why we just don't tell people like the truth or the way it really works or whatever. Maybe then they wouldn't want to borrow as much because they realize, but whatever. We have a situation right now where we have both. We have inflation at 3%, even though they told us it was supposed to be going to 2%. I've been on this 3% target and not 2% target for almost as long as I can remember right now. This is why I don't have any long-term government bonds, any debt, because they have not been targeting 2%. It's complete BS. They have been, if anything, it's like 3% inflation. And that's just how they've been leaning, right? So let's look at some delinquency rates on loans here. And so I have student loans here, which I have a caveat about that. Credit card accounts. These are loans that are delinquent by 90 days. All right. So not making their full payments for at least 90 days. So it's old news. And then we probably get the data later than that. So this is definitely backward looking. We got new student loan data. I think it was today, but Bloomberg had a story out. It's paywalled, so I can't pull it up here, but it says 10% right here, delinquency rate for student loans. It's 29%. Actually, I think I pulled up I think I Googled it. Hold on a second. Here we go. Yeah. This is for student loans. Okay. September 2025, 29% of federal student loan borrowers were seriously delinquent. Okay. 5.4 million people. All right. Haven't fully paid their student loans for over 90 days. All right. So, and then they outline, AI did a good job of kind of outlining this really well. So they have the consequences, credit scores will go down. Also, if you get 270 days past due which will be coming up, they will start garnishing wages of people. Okay. So, and older people over 50 were 18% of those were seriously delinquent. So it's not just people. By the way, unemployment rate for new graduates is over 10%, I think now. So, which is horrible. It's the worst it's ever been when we weren't in a recession. So this data is pointing toward recession. Now, once they start actually wage garnishing student loan borrowers, and they're eliminating kind of all the programs and stuff that kind of gave people a break. So there's not really a whole lot of sympathy on the part of the administration. If anything, they're like doing completely the opposite. They're going to go after these people who owe money, and they're going to garnish any wages they have. So what does this mean? There's 5.4 million people that are now, and people will get moralistic about this or whatever, and that's fine. You can have an opinion about that, and that's not what I'm talking about. I'm talking about the actual consequences of this. Now, this probably doesn't affect too many lenders, because these loans are either backed by the government or they're different than normal loans, and you can't declare bankruptcy with these loans in most cases. So these people are absolutely screwed. Now, I started talking about this in 2022, so this is not a political thing. I started worrying about it in 2022. But President Biden did a bunch of stuff basically to delay all this. Like, they didn't report things to credit bureau. That's what this dip is here. It's not that people weren't delinquent. It's that the government didn't allow them to report to the credit agencies, basically. So it's silly, right? But so it wouldn't affect people's credit scores. But they also delayed all kinds of things. They put all kinds of programs in to try to give people more time and a longer break. And so we didn't go into recession. But I was worried about that back here in 2022, which is actually, this is when it happened, because we had the stimulus money. So this is actually legitimate because there was stimulus money and help and all that stuff, and also delayed, that was going down. But then this drop here in 2022 was the extra programs once the loan repayments started coming back. So this is actually 29%. Now, let's just focus on the purple one here, which is student loan delinquency. You go back to 2009, it's even the 10% that's backward looking is already above that, and it's about where it was going into the pandemic, but we're now going to triple the number of delinquencies that are almost certainly going to turn into defaults. So what does that mean? Well, the government's going to get that money, or whoever lent it to the students, backed by the guy, wherever it ends up going. But one thing, it's coming out of the economy because these people are not going to have as much money to spend on any other stuff, including paying their other bills, right? So now let's look at the credit card delinquents by 90 days or more. So student loans are triple right now, all right, what they were before the pandemic. And far higher than the Great Recession. So credit card accounts delinquent is almost as high as just after. And remember, these are trailing numbers, right? So when you look at the shaded area is the recession, the Great Recession, and you see the spike that happened, and it kind of carries on even after the recession was over. We're pretty much at those levels right now already. And we don't even technically have a recession yet, okay? So, I mean, that's a lot of delinquent credit card accounts. Now let's look at auto loans, all right? So auto loans, we are again basically at the peak of what it was during the Great Recession, which was absolutely horrible. Now the one type of loan I don't have in here are mortgages, and they're doing okay. They're rising. Delinquency rate is rising a little bit, but it's kind of where it was right before the Great Recession. And that's because so many people were able to lock in low interest rates, and we've had inflation. So if you're going to pay anything, you're going to pay your 3% rate mortgage, because it's going to be more expensive to go get an apartment basically than it is to just stay in your house. So no matter what you have to do, if you're driving for Uber or whatever, you're going to you're going to pay your mortgage. So those are better than the Great Recession. Basically, every other type of loan delinquency is worse already without a recession. So what does that mean for banks, right? Well, that means that their biggest risk right now is people defaulting on their loans. And if that cascades, which once all these student loans start getting garnished, it will. And once people's cars get repossessed, and once credit card companies start coming after people for whatever money they have left. So that will damage the economy. It's just a matter of time, because this is backward looking, and I think it could be really bad. Now, the one thing that offsets this is we do have inflation. I don't know if that makes it worse or better. It probably makes it worse for variable rate loans, because if interest rates are still relatively, well, they're not zero like they were post GFC. So if you can lower those interest rates, it could help some of the credit card payments. It probably won't help student loans a whole lot, because a lot of those are fixed. It just depends on the type of loan. But the student loan people are pretty much screwed. It could help car payments. Maybe you can refinance or something like that. Or, you get a little bit of relief there. And then maybe businesses invest more if they can borrow cheaper, and that helps the economy a little bit, right? So you can see why. Now the risk is the inflation side, but they've all convinced themselves conveniently that one-time price increases, no matter how big they are not inflationary. They're just one-time price increases. So, which is, I've already said that's made up. That's just completely crazy. Well, I should say this. It doesn't matter, right? It doesn't matter whether it's better that there's a wage price spiral, because at least that means people's wages are pushing up the inflation, right? So even if it's different than what real inflation is, all right, even if one-time price increases are not inflation, right, it's worse than inflation for normal people, because what that means is wages are not what is pushing up the prices. So people can't afford to buy things. The prices are going up and the wages aren't. If it's a inflation, wage price rising at the same time, like we had actually in 2021 and 2, well, yeah, inflation sucks for lenders at that point, which is why they raised the rates before. But it's okay for regular people, because they're all getting raises, And so, yeah, they're not getting ahead. Their wages aren't really buying them more in the economy, but it's not buying them less like it is right now and how it's going to be over the next year. So I don't want to give too much policy opinion, but investors kind of need to understand this and understand why the Fed is really starting to lower rates. Sure, some of it is, the president wants to lower rates, so he's going to do whatever it takes to lower the rates. But the other part is these delinquencies are going up, and they're going to get worse. And that's pretty clear, because the student loan stuff hasn't even hit yet. They haven't even started garnishing wages yet for most people that are, I think I said 270 days delinquent, right? So you still got 2 more quarters. And that's probably about how long it will take these, if they start cutting over the next several months, for that to take to work itself into the economy. So yeah, I just want to put that out there so people can frame it in what I think is the best way to frame it in their mind. I think the recession risk is, I've kind of been on recession watch, even though I've been buying quite a few stocks, because inflation, well, the risk has always been there since 2022. I've been in recession mode since 2022. But now I think over this 6 to 12 months from now is probably going to be at its highest, because we're going to see tariff impacts, inflation impacts in terms of regular, normal, average people being able to afford things, pay their bills, pay their credit card bills, pay their car loans, pay the insurance costs and everything else that are going up. So it's just worth keeping that in mind, because the market, as we see here, is responding to these cuts very positively, and the trend very positively. And it's going to take time for lower income workers' inability to pay for a bunch of stuff to work itself into the economy and into the revenues and earnings, especially of the S&P 500 companies, the really big companies that have a lot of pricing power. It's going to take a while to do that, but it will eventually happen, right? I mean, the housing problem peaked in 2006, and it didn't really hit until 2 years later. So it didn't hit the rest of the economy in the stock market until a couple years later. But the damage was done earlier, like two years earlier. So that's just worth keeping in mind, not to get too over exuberant on the positive aspects of the rate cuts without remembering that I forget when the Fed started cutting rates. I should have pulled a chart up. I think it was late 2007, maybe. I could be wrong about that. But, they were cutting rates before the whole market completely fell, if I remember correctly, at least a little bit, and then got super aggressive when everything started falling apart. So I would say don't get too exuberant. I mean, I've basically had the same plan in place since January of 2022, and we're almost at almost 4 years. It doesn't mean I'm selling a bunch of stuff. It just means high quality. Think a little bit more about the businesses you're buying, if it's the lower income consumer, and how much they're going, especially if it's kind of on the stretch end of that, like some sort of semi-luxury, that they might not be willing to buy. Anything that requires like a big loan, autos and things like that. It's going to be tough if people's credits are garbage, if credit scores are garbage. So, all right, that's my commentary here. Be happy to answer questions in the comments. And hopefully you just got a different perspective. I'm not trying to tell anybody how to think. I'm just trying to put something out there as a different way to consider what's happening that's way different than the narrative that you're going to hear anywhere else. All right, thanks for watching. I'll see everybody later.